everyone, my name is Sam DeMarco, and my topic of choice was the collapse of the Lehman Brothers. Founded in the 19th century, the Lehman Brothers transformed from a trading company to one of the most well-known and respected investment banks at the time. The Lehman Brothers was accrued by American Express in 1984 and continued to be a prominent force in the industry, making them the fourth largest investment banking firm in the United States. The company's rise in the early 2000s was primarily a result of their large investments in mortgage-backed securities. Simply put, mortgage-backed securities are debt securities that are collateralized by a mortgage or a collection of mortgages. These securities allow firms to profit without directly having to buy or sell home loans. With the Lehman Brothers' reputation being at an all-time high, the company made some risky decisions. During this time, the firm was investing a large amount of borrowed money in hopes of receiving a higher return. The firm offered a bonus to employees when the firm performed well, but did not account for when and if the company would fail. On September 15, 2008, the Lehman Brothers filed for Chapter 11 bankruptcy and ultimately collapsed. This chart from a Yale study displays the Lehman Brothers market capitalization from 1994 to 2008. The chart shows that from 2000 to 2006, there was a revenue growth of 130%. From 1994 to 2006, the revenue growth was an astonishing 600%, from $2.7 billion to $19.2 billion. Their highest peak was in 2007 with $45.48 billion. From then on, the company's capitalization quickly dropped, and by September 15th, it was at $0. The Lehman Brothers collapse was a result from their high leverage, compensation issues, their lack of risk management, and unethical acts. When referring to the finance industry, risk management is the practice of identifying potential risks, analyzing them, and figuring out a way to avoid them as much as possible. Today, the practice of risk management is seen everywhere. Without the correct practice of risk management, businesses and investors could face critical consequences that may include reputational damage, an overspent budget, economic issues, and unrealized benefits. In 1994, the Lehman Brothers ended their relationship with American Express and opened their own risk management portion of the firm. The first chief risk officer of the firm was a former treasurer of Morgan Stanley named Marine Miskovic. Later in 1999, Madeline Antisic was hired to work alongside Miskovic. Both were familiar with not only risk management but mortgage-backed securities. Antisic warned the company of the risks of mortgage-backed securities, but they did not seem to acknowledge her concerns at all. Just 2 years before the firm collapsed, Antisic was fired because of her warnings to the company. She was replaced with an unqualified individual. Because risk management was neglected, the company could not avoid its failure. The Lehman Brothers' decision to act unethical was another key factor in the firm's failure. The Lehman Brothers' debt-to-asset ratio was very unstable, and in order for the company to be successful, they needed to even it out better. In order to do so, they needed to decrease their dependency on borrowed money. With the state of the economy being the way it was not a great time to sell stuff off, as they would not make nearly enough money to pay back the debt. Because of this, the Lehman Brothers took advantage of what is called the repo market. The repo market is a strategy where investment banks borrow money from much larger companies that have a surplus of cash. In order to make the loan more secure, the investment bank would sell the larger company's assets, such as bonds. This made it more secure for the companies to participate because if the bank is not able to repay the loan, the company can sell the bond. The Lehman Brothers did not want their financial statements to show how much they were in debt, so they began to take slightly less cash than the asset was worth. This loophole is called the Repo 105. This technique allowed the Lehman Brothers to remove $50 billion in liabilities off their balance sheet. This unethical act of manipulation was not made public to anyone. By doing this, the company would look as though their debt-to-asset ratio was much better than it actually was. Having a better-looking report may result in individuals and/or firms having more trust in their investment banks. With the company's unethical acts present, the reputation of the Lehman Brothers had collapsed further. Because the Lehman Brothers continued to award executives and employees high compensation and bonuses when they were not financially stable, the firm continued to deteriorate. The Lehman Brothers awarded 50 of their elite workers about $700 million just under a year before they filed bankruptcy. The company awarded bonuses to their top executives depending on the performance of the company, but did not take money away when the company began to collapse. Even with such a high debt-to-asset ratio, the company was still awarding bonuses less than a year before filing for bankruptcy. The company failed to account for their losses and debt. If this money was put back into the company rather than given to the executives, the Lehman Brothers' demise could have been prevented. The last contributing factor in the downfall of the firm was having high leverage. Using borrowed money to increase an investor/firm's rate of return earned on an investment is called leveraging. In order to adequately analyze the financial health of a company, investors use leverage ratios. These ratios essentially tell investors how much of a company's capital is formed from debt. The financial leverage formula is the ratio of the total debt to the total assets. Although leveraging can help a firm's return, it can also have a major impact on the firm when the asset price falls. When the asset price falls, it could be worth less than the loan itself, meaning that even when the asset is sold, the firm/investor would incur debt. This was the case for the Lehman Brothers. The Lehman Brothers used borrowed money for mortgage-backed securities. Once these securities were found to be worth less than the firm thought, the company was in danger for debt. According to a study conducted by Yale in November of 2007, Lehman reported a leverage ratio of 30.7. Their leverage ratio rose and reached this number due to their interest in mortgage-backed securities. During the Lehman Brothers crisis, the firm overall had very poor decision-making. Their management lacked insightfulness to safely make risky decisions for the firm, ethical value systems, and ignored the complex issues brought up by professionals regarding their firm. The decisions made before, during, and after their collapse could have been avoided with effective decision-making. A liberal arts education allows students to develop and strengthen this skill. At Emmanuel College Chemistry Lab strengthened my ethical system, my ability to navigate a complex business world, and my ability to examine the actions of others and how it shapes the world. In chemistry, before every class, everyone must read the lab and do the pre-lab. The pre-lab consisted of figuring out the amount of solution one must use for the reaction and learning which chemicals are going to be dangerous. During one of our labs, we were experimenting with acids and highly reactant chemicals. My lab partner did not come to class prepared. Because she was not prepared with the formula or solution amount, she quickly did them during the experiment. In chemistry, before every class, everyone must read the lab and do the pre-lab. The pre-lab consisted of figuring out the amount of solution one must use for the reaction and learning which chemicals are going to be dangerous. During one of our labs, we were experimenting with acids and highly reactant chemicals. My lab partner did not come to class prepared and rushed to do the equations during lab, which resulted in her making quite a bit of mistakes. Luckily, the lab assistant caught her mistake before moving forward with the lab. Because the chemicals we were dealing with were so hazardous, this could not only have harmed us, but others in the room. After this lab and seeing this situation occur, it allowed me to realize that being so disingenuous to yourself and others does not benefit anyone in the long run. This situation strengthened my ethical value system and also helped my ability to examine the actions of others and how it shapes the world. In terms of navigating a complex business world, chemistry taught me to be precise, and that is essential to not only the business world, but the world of accounting. Being precise allows for one to eliminate errors. An example of this would be in the tax industry. If one is precise while doing a tax return, the refund/amount due will be accurate. A liberal arts education is necessary to help effective decision making.